Hello, everyone. We're starting our next panel. My name is Yinka Ibukun, and I'm West Africa Bureau Chief for Bloomberg News. So our panel is CBDCs and Crypto, a brave new world for African finance. From Nigeria to Ghana to Kenya, central banks have shown a lot of activity and creativity in the digital currency space. At the same time, some countries, including some of these CBDC innovators, have shown some reluctance towards crypto. We're here today to look at the tensions, but mostly to look at the opportunities that the expansion of the traditional financial system presents. To do that, we have a diverse set of experts with us today, but before we get started, we will also have an expert presentation. Our panelists today include Togo's Minister of Digital Economy and Transformation, Sina Lawson. Madame la Ministre. For the other panelists, please hold on. We'll actually join the stage later on. Our other panelist is Esther Chibesa, who's the MD and co-head of Treasury and Trade Solutions for EMEA Emerging Markets at Citi. Then we have Vikash Thakur, CEO of Financial Services Commission of Mauritius. We have Mamadou Touré, founder and CEO of Ubuntu Group, and Antti Arponen, founder and CEO of People, a payment service provider with operation in the Middle East, Africa, and Central Asia. But before we start our conversation, I'd like to invite Wale Abioye, a partner, strategy and customer solutions at KPMG. Wale, you have the stage.
All right, thank you very much, Yinka. So I have maybe the easiest job here this morning before the panel starts. Like Yinka introduced, from yesterday, the very first session we had, we've been hearing a lot about crypto and CBDCs. And that's because internationally as well, we're seeing a lot of interest from central banks. And one of the favorite stats now is that about 90% of central banks around the world are either piloting or trying projects around the CBDC. You've probably heard about the CBN in Nigeria that has launched the e-Naira, or in the Bahamas, where we have the Sand Dollar. So we have central banks around the world showing up around the topic of CBDCs. And what's clear is that we see this as a natural evolution. So we've gone from gold to paper money and now to digital currencies. But then maybe paradoxically, we're seeing less enthusiasm on the continent around cryptocurrencies. When you look at central banks, not many showing a favorable disposition towards cryptocurrencies. Now, cryptocurrencies is clearly different from CBDCs, central bank digital currencies, more of digital currencies that are backed by the fiat currency, which we traditionally know, whereas cryptocurrencies are based on distributed ledger systems and are not backed by central banks. So the clear difference in that. Now, what we're seeing with central banks may be at variance with what we're then seeing with retail investors or retail customers or users. So if you look at the table to the left of the screen, you find that in terms of crypto adoption around the world, 6 of the top 20 countries actually are in Africa, including our hosts, Togo as well, and Nigeria, where I come from. So you see a lot of interest from day-to-day users. And what's driving the interest? Currency depreciation. Many of our markets not doing very well currency-wise this year. Next year, we expect to see a lot of elections across the continent. And for many young people, cryptocurrencies representing maybe one way of hedging against their own risk. Just given the depth of capital markets that we have on the continent as well. Cryptocurrencies as well, one means of remittances for many young people as well. And the fact that traditional payments today continue to be costly, they are not as fast as they should be, for many customers as well. Now, despite all of this, we've seen the real risks and challenges. We've talked about the collapse of FTX, as I'm sure the panelists will talk about that in a bit. And you've also seen the volatility around Bitcoin in the last 1 year as well. Now, even for CBDCs, there are also risks as well for the banking system. One is the potential risk around stability. Because where money then becomes directly, in a sense, intermediated by central banks themselves, if you had financial crisis, you may then find retail users or customers trusting the central bank over the traditional banks. So that's a real risk. Around the infrastructure that is required as well, even though many central banks, as you saw at the beginning, trying this out, there's significant investment that is required to implement this. And of course, cybersecurity considerations as well, challenges around the AML on the crypto side for many countries. And then finally, even for CBDCs as well, potential challenges around data privacy, around security as well. So these are some of the risks and considerations as we look at implementing CBDCs or cryptocurrencies. But then there are real opportunities as well. So financial inclusion in many of our markets on the continent, still less than 50%. Some markets perhaps doing better than some others as well. But what this allows us to do, as we've seen with mobile money, as we've seen with digital payments, is that it allows for quicker and more scalable inclusion of customers across the continent. Now, for this as well, CBDCs on one hand could allow for offline payments as well. So as we continue to see low penetration of broadband across the continent, this potentially could provide the opportunity to do payments without requiring internet as well. I've talked about cross-border payments. Cross-border payments, one of the biggest use cases when you look at remittances. The table I showed on the previous slide, when you look at the countries on that list, there are also countries that have the highest volumes of remittances. So you see the interplay between the adoption of cryptocurrencies and remittances as well. And for CBDCs, potentially could provide central banks a stronger mechanism for shaping monetary policies in those markets as well. Now, on a final note, as we have our conversation, what are the key considerations as we look at crypto adoption or perhaps CBDC implementation in our markets? One is around ensuring that we have robust and consistent regulatory frameworks. One of the biggest challenges for operators within the markets, whether commercial banks or fintechs, is the lack of clarity around this. So on one hand, the central banks favoring CBDCs, and then on the other hand, perhaps sometimes being ambiguous around cryptocurrencies, what banks or fintechs are allowed to do or not. It's clear that as we do this, it's important that we also begin to think about industry standard risk management controls in place, either at a national level or at regional levels as well. And given the data privacy and cybersecurity challenges, we also then need to be thinking about next level cybersecurity, because as you've seen recently with the collapse of one of the biggest exchanges in the world, for many of our markets where individuals are perhaps low to middle income, it's then important that we're protecting their assets. And then finally, is thinking about the customer experience as well. So customer experience both ways. One, looking at CBDCs and crypto as an opportunity to deliver even more seamless experiences for customers. And then just in designing the solutions as well, ensuring that they're easy and seamless for people to use. So that's the presentation. I'll hand over to Yinka now for the panel discussion. Thank you.
Thank you, Wale, for that very insightful presentation that really sets the tone for the rest of our conversation. I'd like to kickstart by discussing trust. So Wale touched on the implosion of one of the biggest crypto exchanges, FTX. And I would love to start by just asking, what role does trust play in the adoption of crypto and CBDCs and other digital assets on the backdrop of what happened with FTX?
Thank you. So I think what is important when you understand the crypto market is that first we need to differentiate crypto and blockchain. Crypto uses blockchain technology to install trust in transactions, right? And in that way, it uses cryptography. And just for me to summarize quickly, what it's done is that any transaction somehow get recorded simultaneously, let's say on thousands of computers, so that you can't tamper that information. It makes it immutable, traceable, right, and tamper-proof. That is the trust element of blockchain. And it was created after the 2008 financial crisis because there was a lack of trust in the financial markets, right, with the too big to fail and so on. So how do you remove the middleman who can cook the numbers, right, ex post or ex ante? Then that technology came out. And it solves a very interesting equation that took a millennia to solve, which is the Byzantine general equation, using cryptography to solve. So blockchain as a technology is the most advanced trust-based technology known to human history to date. Now, when it comes to the market, that's a whole different story, right? What you've seen is indeed the crisis with FTX. And the trust did not come from the technology. It came from human decisions of misusing, right, third-party funds. But why was it so fast to effectively catch? It's because the blockchain is transparent. Where I was sitting in my lounge, I could go to the blockchain and see exactly what transaction FTX was doing. I can't do that with JP Morgan. I can't do that with Goldman Sachs, right? That's the power of blockchain. Now, the reason why it all collapsed as an whole is because ultimately the market is still very small. If you take the crypto market, you're talking about $1 trillion, 1 to 2 depending, but now more around $1 trillion industry. The global financial market industry, it's $750 trillion, out of which global stock market 125, and global bond market, debt market, 125 trillion. So it's still a very small market. Therefore, when something moves, it's like you're throwing a small stone in a glass of water. You're going to have a lot of waves, right? And also the other thing is because it's backed, the main assets in the crypto industry known today are mostly Ethereum and Bitcoin. Both of them represent 60% of the crypto industry, roughly. So it's the biggest element. So, and most of the actors use that. And both of them are not backed by a particular asset, they're backed by a network, if you may. Now, what we've done at Ubuntu Tribe, we took a bit of a different approach because we knew about all those challenges. An asset that is backed by nothing is going to be hard to sell, right? And we decided to get Africa to play to its strength. What do we have? 48% of the global gold deposit, 80% of the platinum, 70% of the diamond, you name it. So why don't we tokenize our natural resources? So that's what Ubuntu Tribe did. And if you look at the chart here, and this is important, you look at the FTX drop. First, you'll see Bitcoin and Ethereum lost 64% or 66% since the beginning of the year, right? But the NASDAQ also lost. But because the NASDAQ has more depth, it only lost 28%. And on the same day when Elon Musk announced that he's selling $4 billion worth of Tesla, the share lost only 4-5%. But when Binance announced that he's dropping the FTX share, it lost 80%. Now, point is, when you're backed by gold, which is what we've done, if you look at the chart, you're not subject to the coefficient of correlation in the market, and that's where Africa needs to play to its strength. The crypto is actually a trust. The blockchain industry and crypto is trustworthy, even more so when it's backed by assets. So we need to tokenize our wealth as a continent.
So we're going to get to the applications of blockchain later on. But I'm just curious to just get the pulse of the room and see, in terms of, I mean, you've really explained to us, Mamadou, why the trust system is basically unharmed, even by the latest development. You don't see any lasting damage. And you've explained why, even technically, why that's the case. But I guess for people just dipping their toes into crypto, I'm wondering if there could be some sort of damage. And to answer that question, I'd love to just put out a survey to the room and see if, by a show of hands, if today you feel just as confident as you did a week ago, and maybe you never felt confident, about holding crypto or even buying crypto. If you could just do that by a show of hands so we can get just a visual survey of the appetite for crypto in this room post-FTX. Okay, that's just about a third of the room, maybe even less than that. So there is still, I think, even if the technical side of it.
If you asked at the end of 2008 financial crisis about the mortgage-backed security, who would buy stocks, people would say no, right? I mean,
so there is some sort of impact on trust. I mean, this is not a decisive, but I do think that.
Can you ask who would buy gold today?
Okay, who would buy gold today by a show of hands?
Much more.
Okay.
And who would buy gold tokenized, basically? Same thing, it's still gold. You still have the room, right? That's where Africa is going.
Who would buy gold tokenized? Much less people. Less people than crypto.
Still the same.
Okay.
Oh, okay. She wants me to explain the notion of tokenization.
No, we will get to it.
Okay.
We will get to blockchain. This was just to get a sense.
Yeah, true.
So there is interest in crypto. But there is some reluctance as well. But given that it's part of the global conversation, we'll see how it can fit into the traditional finance system. And so the next question I have is, to begin with, what are some design choices that would encourage financial institutions to participate in digital assets more broadly, beyond just crypto? Esther, would you like to speak to that?
Thank you, Inka, and thank you, Mamadou, for a really interesting overview. I think to answer that question, we start with this idea that digital assets are is a name for a broader category of assets, right? So there you would have not just Bitcoin and cryptocurrencies. You would have, things like CBDCs, right? You would have, some of the cryptocurrencies. You would have tokenized forms of assets, etc. So it's a broad group of items. I think financial services institutions have a particular role to play in preserving the trust of the customers that they serve. And they possess a territory where they are regulated by necessity to make sure that you can all continue to trust financial services, whether these be banks or non-banks. And so in thinking about designing the ecosystem, I think there are really three things we have to think about, right? The first is, what is the role of central bank money versus commercial bank money? And by that I mean this. The design choices should try and protect private investment and credit creation. So let's not forget that this piece of technology must deliver something, must deliver value. Either it's delivering a payment, or it is a store of value, or it is some are fungible, they can move from one to another. So the first thing is that it must protect the private investment activities as well as credit creations. And that means CBDCs specifically should really not crowd out private investment. They shouldn't crowd out innovation in payments, meaning there is space for everyone, not just banks, but the fintechs and the non-banks that provide services. And at the same time, they should drive things like job creation, social mobility, etc. The second thing is to think about public infrastructure versus private sector solutions. And what do I mean by that? You really have to think about interoperability. Design that money or activity can move from a public platform to a private platform. So it should be the case that CBDCs, for example, should allow value to transfer seamlessly from these ecosystems, both domestically as well as internationally. And they shouldn't result in incremental obligations on regulated financial institutions. And then the third thing I want to say is that we really have to think about the expanded use of digital money and what that means from a risk of financial crime perspective. We cannot ignore that. I think you told us, in the end, moral hazard is moral hazard is moral hazard. So you have to think, how can you optimize privacy without compromising stability and financial security? And you have to limit new challenges for consumers. You cannot introduce things which then make it even more difficult for consumers to use.
Thank you so much, Esther. So you've really broadened it to digital assets, and so I'd like to bring in Sina about what are the opportunities as the public sector representative on this panel. What are the opportunities that you see from the government perspective for the expansion of digital assets, the use of digital assets?
So it's a great question. Hello, everyone. The first thing I want to say is that all these conversations are not about the technology. These are not technical conversations. It's really for us, states, to understand how to fill certain gaps that have been poorly filled in the past. When we talk about, for example, financial inclusion, or when we talk about lowering the cost of transaction, of cross-border transactions, or when we talk about increasing liquidity in the economy. So these are, it's true that 10 days ago, it was 10 days ago when FTX crashed, everybody was looking at it and maybe wondering whether it was the end of crypto and crypto exchange platforms. But I don't think so. I think for our continent, it is a unique opportunity. As a digital transformation minister, I'm very fortunate because this is one area where Africa can show the way, and that's why it's so important, all these conversations. So in terms of increasing liquidity in the economy, we're part of the CFR franc zone, and sometimes when you leave the capital city to go into rural areas, people don't have any change. So if you want to buy something at a very small amount and you don't have change, the transaction does not happen. So, so for us, thinking about crypto should be a way to improve and solve these challenges. Yesterday, Adeyemi was saying that what he recommended, and I think he's right, would be to have a gathering of various stakeholders to try to set up some rules to start, thinking of ways to implement them in West Africa. It seems to me that a lot of the conversations that are happening, Togo, for example, is a country where there's a lot of crypto transactions, but these transactions are made outside of the, of our legal framework. We don't know what is happening. So I think it's also important, while recognizing the importance of crypto and CBDCs, to understand how we put the right framework in place to make it happen.
And what are some applications that you see for crypto in the Togolese context? So
one application I would say would be government to citizens payment. During the pandemic, as you may have heard, we developed a cash transfer, a digital cash transfer program, Novici, and we were able to pay out 25% of all Togolese adults. So for us, once you have such a large payment platform, then the types of payment that you add are just applications you add on top of other applications. And one of the things that could happen in terms of social protection would be to use digital currencies in order to support, the poorest individuals. So that would bring yet another layer of innovation and of leadership, really. That's what the continent wants to do. We want to show leadership in terms of digital transformation, and it's global leadership we want to show.
Excellent.
Go ahead, Mamadou. You want to add something?
I mean, she's spot on, and based on what I just heard, right? So we had a rollout strategy for Africa, some countries, and I'm actually thinking of setting up in Togo based on what I just heard. Should I challenge you on that one? Right? And
yes,
have a conversation?
But
and because if you've already set up this whole transfer you're ready. You're ready. You're probably one of the most ready on the continent at this point.
I'm not sure because in order to implement it, we have to have the support of the central bank. So there's a third player in this conversation, which is the central bank of YMU, which is one central bank for 8 countries. So how do we bring this regulation into the level of the central bank, knowing that it operates in 8 countries?
It's beautiful because we're not a currency, we're just a commodity.
And, okay. And speaking of central bank, what about CBDCs? You've spoken about crypto. Do you see space for that? And do you see that deepening financial inclusion in Togo and in the broader region?
So I know that Nigeria has this e-Naira, the Central Bank of Nigeria, that Ghana is also looking into ECD, CBDC. As far as the French-speaking CFA franc zone is concerned, I'm not sure of how to implement it for 8 countries. In an ideal world, we would still, have a sandbox and try it out, because it's really through trials that we should see what works. I also want to say that in the light of the African free trade area, these are subjects that are very important to us, because if we can find ways to really improve cross-border transactions and to make sure that the continent, because we've been talking about this forever, the fact that, yes, we are a continent of 1.2 billion people, but this market, we can never actually access the market because of different regulations, different currencies, etc. So for me, it would be, nice to start thinking maybe of CBDCs and others to see how we can have one single payment system for the entire continent, or interoperable payment, digital currency systems.
Maybe you want to mention Ghana, what they just did with gold to buy.
Oh, yeah. But you can mention
Mamadou, we'll move from tokenizing commodities, and I'll bring in Auntie on the issue on CBDCs. So, Auntie, what do you see as the role of payment companies, banks, and central banks in CBDCs?
I'm going to simplify this relatively complex topic quite a bit. I think nothing has changed. So the central banks and the commercial banks, they issue money. That should be their sole right to do it, and nobody else. Then there's capital markets. They sell and trade on secondary markets. That's their right. Then there are this new breed of payment service providers like ourselves, whose job is just to move money. And then there's the regulator whose job is to supervise and be a place of contact. Is if a customer has a problem, they have a place where to go. And these fundamental things have changed not at all. They're not going to change, hopefully. Maybe out of these players, the only one that is a little bit new, which is a bit less known, are the payment service providers. We're kind of just a humble, small thing. Our job is just to be the lubricant in the engine. Just make the money move a little bit smoother. And we do that today, whether it's digital, central bank digital currencies, or traditional fiat money. But we have to be regulated. We want to be regulated because it's in our interest as well that the consumers are protected and the businesses are protected. So again, nothing has changed. Then comes the question like, okay, so why are we even talking about these CBDCs? And Mr. Vikash, you had an excellent point yesterday in a roundtable that just always start with the simple question, which problem are you trying to solve? And these CBDCs, they make moving money a bit faster, a bit cheaper, sort of safer, and definitely more traceable if it's done properly. So that's really it.
So I think Antti has thrown the question to Vikash. So if you could tell us, are CBDCs for everyone?
It depends on the use case. If I take back a bit the history, let us look at the IMF Bali FinTech agenda. That was when central bankers started getting interested to come up with their own CBDCs, and work had been done. And the point or the objectives in those days was whether central banks were themselves under the threat of being deprived of their actual sovereign right to issue money and to do monetary policy. And it was thought that if the people have an appetite to go for digital, to go for means of payment that are central bank digital, and the digital has got a very important word in it. If the digital, they meant in those days perhaps crypto as well, but is to use the blockchain, etc. Some experiments had been done. And at the end of the day, what actually boiled down is that central banks moved forward, and we have the example of Nigeria, where central bank has come up with digital currency. Same for Bahamas. I would say that let us look again into what would be the implications. Since 2018, we had the pandemic, we were 22, so a number of years have gone through. And what has been, under these days, any direct threat of the traditional cryptocurrencies on the central bank sovereignty? We see that something has now settled, has taken shape. And if countries, excuse me, who have already a very robust preset means of national payment, I don't think central bank digital currency would add a lot in it. The difference is that the central bank digital currency happens to be, first, it is the liability of the central bank and would be a legal tender. But the extent to which, if there is already a very robust payment system, we would wonder whether it might make an effect. But where countries are now coming up and developing, they could move to the next stage straight away. The biggest problem that central banks will solve would be that the smaller operators need not put all the systems around to guarantee that in case they go bust, the people are reimbursed because they have a claim directly on the central bank. So it depends on the situation.
Great. And so we've mentioned CBDCs, where relevant, cryptocurrencies, mobile payment platforms. Touching on something that Sina mentioned earlier about regional integration, I'd love to bring in Esther and ask, how do you see all this multiplicity of payment options impacting regional integration?
So I think, all of these things pose interesting opportunities and interesting challenges, right? So let's use a simple example, right? Mamadou, I hope you don't mind. You've given us an interesting overview of what you do. And those of you who know Ubuntu should, or you maybe go online and check out what Ubuntu does. But, how would one classify the activity? Is it a security? Is it a commodity? Is it a derivative? Is it a payment instrument? Or is it all of them?
It's actually a very good question.
But only give me one answer.
We classify it as a commodity, and people do whatever they want with it.
However, if you do barter trade, is it a payment instrument?
Yes, because you're smart enough to put an entity in between that will buy from one, sell to the other, and it's...
But if I take that same transaction one more time and I split it in pieces, is it a security?
In the rule of the SEC...
We're doing innovation now.
Yeah, in the context of the SEC, if you're buying it with an objective to actually make a profit of it, you get classified as a security.
There you go. So just to make the point, if we come back home to the very first idea, that although we speak about these things, let's not forget that all of these digital assets, can possess, they can start
Different
as one class,
features,
but they can actually possess different kinds of classes, right? So now let me make my point. What does that mean? Just imagine payment instruments, assets, tokens, securities, commodities, derivatives, all of which are inside of the financial markets in one market, and then interconnect that into the rest of other markets. So let's say I can move my gold from Nigeria to wherever, okay? Now, using that simple example, what are some things we really need to think about? On the one hand, maybe there are opportunities there for greater trade, for simplifying transactions, for deepening capital markets, for creating new types of markets, for bringing investors and other players into spaces they might otherwise never have possessed. I was speaking with here, Mr. Nesbitt, that yesterday we were in a panel and we were talking about pastoralists in Kenya, the Maasai, whose wealth is stored in cattle. This idea of where your wealth is stored is age-old. It's not new, Just because it's now digital doesn't mean anything has changed. Could communities like that digitize their wealth? Is that beneficial? Is it not? What are some challenges when you include those kinds of asset classes? Maybe you need to think about educating. Maybe you need to think about access. But I think the points I want to make here, having made the point that digital assets themselves cover a really broad range of classes, when we start to interoperate, it starts to get a little bit more complicated. And here are some things we really need to think about as we expand that into regional integration and what have you. The first thing is you absolutely have to have regulatory clarity on what a digital asset, what is the class. So using that example, in every moment where that transaction is shaping itself in life, what is it? What is it? That's important, right? You have to make sure that you're classifying it correctly. And that is the job of regulators, to designate that in a market, and there are different types of regulators that have to do this work. I think the second thing I would say is that it's important not to duplicate regulatory frameworks. So there may well be good baseline regulations, good baseline policies, but what regulators really need to think to do is how can we enhance those so that we don't overcomplicate the environment and make it even more difficult to do business. The other point I would make is this, and it's an important one. The same activity should have the same regulation, right? And by that I mean this. You should base your regulations thinking about what is the asset, what is the supporting infrastructure, whether it is legal, whether it is technology, etc. You really should think about those things. And then how should I regulate them? In the same way as you would traditional assets, right? So you have to think, how should I regulate them so that I can promote competition and reduce systemic risk? And then the last thing I'd say is really, really never to forget that as we interconnect markets, what are we introducing? Always the risk of financial crime. So thinking through how do we make sure the space remains secure.
And so on that note, I'd love to take it to Vikash as the regulator representative on this panel, and just to hear from you, what sort of steps are being taken to manage risk?
Manage risk with the normal cryptocurrency.
Will the multiplicity of, with the financial complexity that we've just described, what kind of measures are being taken to either prepare or things already being done to manage the risk?
If we take the classical route, we can always come out with what are the risks and the risk associated with digital and cryptocurrencies in terms of the trading, not in terms of the technology and the blockchain itself, is basically, and which we say is the volatility. And with the volatility, we have the problem of the liquidity, as well as this risk that the investor might lose all the capital invested. And on that perspective, it is not very different from any other market. The only difference is that nobody gives you a guarantee that on a stock market, it is not going to crash. But the regulators of the stock market make sure that there are thresholds. If a share price goes beyond certain limits, you see there are automatic mechanisms come to stop, to let the heat go out, and then to rethink. Whereas these are now just new things, so this is very important. The second point is in terms of the liquidity. If you think that your asset or crypto asset was this, is it actually, if tomorrow you decide to buy, or you're going to get it? I'm not talking about the mainstream cryptocurrencies, but there are a plethora of them coming in. And this is the question that we need to ask. And whether they come up just as a speculative force or they come up as a set price, comes with it related to it, the education. And I'm talking about the education of the whole range of people, the financial literacy behind not only the end customer, the financial literacy even of the regulators, the financial literacy of the operators. Everybody should be aligned to ensure that if you see volatility, it is not a question of telling this is the end of the story. The volatility comes naturally, and what are the reasons? In Mauritius, we have started regulating the domain of virtual assets. I'm not talking cryptocurrencies. I'm deliberately choosing this word, but the domain of virtual assets. And when we came up with the act, we started in parallel with a massive campaign on customer financial literacy to bring alignment. And we discovered, to our dismay, that a number of people who were the intermediaries were actually telling a story where they didn't understand what they were doing. And that was very important, so that the end customer, we say the simple word that we said, be transparent. If you see you're talking about a story of some people getting rich overnight, tell the other story that you can also come to rags overnight. And this is important. The last point I would say about is the question about the technology risk. And for this to be able to contain, this is where we believe that the operators should come into the regulatory space, whereby there should be parameters for them to follow, and there should be obligations for them to respect.
So in the context of Mauritius, you started regulating virtual assets. For the regulators in the room, is there a risk to being left behind? a risk to not adapting their regulation to these new sets of assets?
I believe there are two areas. If you're talking about central bank digital currency, I already replied to it. But when it comes to virtual assets, I would share with you an experiment that we did and we were required to do. Is first, we call it this famous recommendation 15 of the FATF. We all jurisdictions will very soon come to face it. And in Mauritius, we took the bold step to let us get ourselves compliant on it. And to get compliant, you need to do basically two things. You must have legislation regulating the world of virtual aspects. For those who might not be aware, just like to share, the FATF recommendation 15 talks about the virtual assets and how money laundering could be done. So, which means that regulators now have already an obligation, because you can't be too long away from any recommendation of the FATF, so regulators have to act. And secondly, what it requires you to do is to start tracking activities within your jurisdiction in terms of crypto assets. There are tools that enable you to do that. Then, what happens? We discovered that there were billions worth of transactions going through our jurisdiction, and perhaps our people were involved in it. So we had no other option than to come up, to start regulating, and to put some order, so that at least we face two things. International standard setting bodies, we tell them, look what we are doing, and as some operators come confidently, and this is the framework in which you need to operate.
Thank you so much. So I'm going to ask one last question to Mamadou, but I just want to prepare everyone. If you have questions, I'm keeping the last 10 minutes for you. So please, Mamadou will have 2 minutes, and then we'll open the floor for questions from the audience. Mamadou, I'd love you to expand on the applications of blockchain technology.
Okay, thank you. So I would like to go back on what problem are we solving that you guys asked, right? And I'll go back a bit in history. Personally, technology for Africa is the tool to leapfrog. You saw it with M-Pesa. You saw how we leapfrog fixed line with mobile, right? The next revolution is digital assets and blockchain, right? I've been lucky to be involved when I was at the World Bank, IFC, investment banking, at the forefront of all of them. This one, as much as internet and GSM mobile was an empowerment movement, blockchain and crypto is a liberation movement. Why? Because you need to understand how finance works. The problem we're trying to solve is shared prosperity and financial inclusion. How does finance work? It's based on two things: asymmetry of information and collateral. Asymmetry of information means that I see value in this that I think will go up and you see will go down, and therefore I'll buy or sell. But the main thing is collateral, right? Now, Bitcoin, Ethereum are not collateralized, but if you understand how African economies work, the most powerful lender in Africa is the African women in the village. Why? They have tontine, as we call back home. They have susu, as they call in Ghana, stockfels, as they call. Why do they have 1% default rate while most banks have 30% default rate? It's based on trust and traceability of assets. I know where you live. I know your surroundings. There's a peer pressure. Blockchain works the same, right? So now, if you can collateralize an asset, I don't know if they can put the chart,
No,
and say, no, but it's important. If you can collateralize an asset, right, what it means that I don't need, as a bank, to go and check your car, to go and check your asset. It's all on the blockchain. So your real estate, I can fractionalize ownership, meaning that if you don't have 100 million CFA franc to buy a house, but you have 100 CFA franc to participate, and you have a million people who participate, in that small piece of real estate. That's how you create shared prosperity. Why? Because the collateral is identified, immutable, traceable, and so on. So applications are just infinite. Now, when you look at decentralized finance, which is the future, and it's actually happening now, it means that anybody can be a lender. You have a bit of savings, right? So what are you going to do? Keep it under the mattress like we've been doing? No. You put it on a blockchain in a decentralized finance platform, and then you get a bit of interest. So it's a participative economy that blockchain allows when you ask to answer your questions about how, and to come back to one last thing, right? The collateral itself, we're probably the luckiest continent in the world when it comes to collateral. Did you ever know why those mining companies, and I've funded many of them, right? Either with GE or with IFC, right? They sit on a lot of concessions, and only one gets exploited. What do they do with all those concessions sitting? You think it's sleeping?
Yeah.
No, it doesn't, my friend. You know where it goes. It's a collateral so I can get loan to fund the 1 out of 10 projects. We don't know that. This needs to change. That's why I'm here, right? So
on that note, we really have to open to the audience. You have lots to say, and if you're curious to know more, please meet Mamadou. I have a question in the 3rd row. I don't know if you can get a mic. Est-ce qu'on peut avoir un micro au 3e rang, s'il vous plaît? Oh, we have another one here. Okay. On a une main de ce côté-là et de ce côté-là aussi. Okay. Thank you.
Hello.
Yes.
Bonjour à tous. Thank you very much for this very, very healthy debate to start with. I co-lead a startup that's entirely CBDC focused, and it's probably the only one in Africa that's born and based in Africa. I'm really fascinated by where the debate went. My question is, when you look at CBDC, there's actually 2 branches, very distinct ones with very distinct cost benefits. The first one is retail, which is what you described, but the second one is wholesale, which is interbank clearing, central bank to central bank transactions, and cross-border transactions. The wholesale CBDC does not disturb anything in the economic fabric of the country. It's only between highly vetted actors. And I just wonder what the panel thinks about the opportunity, the likelihood of wholesale CBDC to come to life. Because we are a CBDC startup. We've seen with great pleasure the e-Naira. We see that Ghana and maybe Madagascar are moving forward. But there isn't any other willingness in Africa, to the point where we are actually consulting with the ECB for the digital euro and with France for its experimentation, but we don't have the same echoes in Africa for CBDC. Thank you very much.
Anyone want to take that question on wholesale CBDCs? Okay.
You can. You're a regulator. Please take it. Let the regulator take it.
Vikash can get us started.
Let me take part of it. You may add.
Sure.
The wholesale CBDC, in my view, is the first step towards the final retail side of it. If you look at the evolution of payment systems, all payment systems started with wholesale payment rails between the central bank and its banks. And that's the famous RTGS, real-time gross settlement payment. And these are the channels that allowed, therefore, banks to have an account with the central bank and then do the transaction. And now when we talk about the wholesale CBDCs, it is just one step. In the design, it is simpler, as you mentioned, because it acts towards those people who are actually they are aware of it. But one question that I always like to ask, when we're talking about CBDC, which portion of the broader money supply are we talking about? I'm going a bit technical in terms of the central banking language. We know that it is M0, the money supply with respect to paper notes. M1 is M0 plus the electronic money. And when we are talking about the central bank digital currency and we want the space of M1, But most of the interbank payment systems currently already work on M1. The only difference is the shift of liability from the central banker to the commercial banker. I do believe that if you are talking about seriously about CBDCs, it has to be an electronic version of the M0. Otherwise, you will find that it just goes back into the space of the commercial bank holding the money. It's an account debit, and I don't see any difference from that one to the current one.
I wouldn't agree on that, because since 1971, the dollar got decoupled from the gold, right? And all of the M0 at this point is backed by ZIP, right? So either we continue on fractionalized banking backed by thin air, or we start looking at something backed by something, right? If you look at the repetition of financial crisis since the decoupling from the actual underlying asset, it repeats every 5 to 10 years. So if you look at China, the CBDC is actually 20% backed by gold, because they know the old model is not working. If we're going to think of CBDC, especially as Africans, we need to rethink the whole point, right? Because if you really want your currency to stop depreciating, you can't repeat the same mistake and expecting a different result. I would say, again, look at the assets that you have, create a new M01 or M0 Plus if you want, and then start building on that. If not, you're going to remain poor for the rest of your life and for the generations to come. Can't happen.
Thanks.
We're not that stupid, are we?
Esther, you had something to add? Thanks.
Yes, I was just going to say to the gentleman there that I certainly have found that central banks are willing to listen to good ideas. And, you know, here you are in a place where there are plenty represented. And that to the extent that you have absolute clarity on the problem that you would like to solve with a wholesale CBDC solution, you should bravely engage. I would always encourage optimism. This is a continent where there is a thirst for technologies that solve problems, both for financial as well as digital inclusion. So be brave and make your suggestions.
Thanks so much. We have time for one more quick question. Yes, in the third row.
This is working?
Yes, we can hear you.
Okay, thank you very much. My name is Hassan Mahmoud. I'm the Director of Monetary Policy at the Central Bank of Nigeria, and also part of the technical working group for the CBDC in Nigeria. I think I like the point he made, that nothing has really changed. And it is important that, and I'll give one analogy. The only reason why you go to the airport, enter an aircraft to fly to London or America without asking for the pilot license of the pilot. You just go in, you don't know whether he can fly a plane or not, you don't even know who is sitting there. You just go in and you are going to the United States. The only reason why you do that is because you know that there is a regulation. You cannot come to the airport in a uniform with 3 stars and they allow you to pass and go into an aircraft. There are regulations, there are procedures that guide that. The only reason why you will see a policeman standing or a military man standing with a gun and you go to him and be talking is because you know that the military man cannot shoot you, because if he shoots you, there's a law that you will be killed too. And you know those laws are implemented. What I'm saying here is, the resistance you saw from central banks to crypto and all that is one, it's a state, you know, and a state cannot stay ungoverned. This evolution or revolution or tsunami came where central banks don't understand what it is. And you cannot run into the field with a Kenya marathon racer when you have not even practiced 1 kilometer at home. So like the Central Bank of Nigeria, we didn't ban crypto. We can't even ban crypto because it's not within your space. But do not play within our exchanges because we want to protect the depositors' fund, which is responsible to do. So, and now, as we're getting to understand it, you know, there are programmable monies. The CBDC we did in Nigeria is retail. And principally, what we wanted to achieve is financial inclusion. I think the guy there mentioned it. You know, programmable money, we want the fiscal authorities to also use that to collect taxes. The blockchain technology is what we're adopting. We are seeing things, smart contracts coming out of there. The understanding is coming, and the acceptance is coming into it. But for the public to know, cryptocurrency is not a currency. It's maybe you can call it an asset, and our Security and Exchange Commission in Nigeria is also, you know, bringing those people into their own space and seeing how they can. So I think we should be learning from each other. You know, the blockchain technology is being adopted, and we're taking it. So it shouldn't be a fight. You know.
No, there's no fight.
Thank you.
Yeah. So
I have a question for you. Just one last thing.
Sorry.
I have a question for you.
I'm not a panelist.
No. Don't you think our currencies are a prison? It's very important. Everywhere I travel, I can't use my Naira. I can't use my CD. I can't use my CFA. Okay. I'm in jail.
Sorry,
I don't think you guys realize how much of a problem it is, the current system as an African, right? We need to wake up.
Okay, on that note, thank you so much, because we have actually run out of time. I want to thank you for the really healthy debate, the very healthy debate we had on stage, and the wonderful contributions from the audience, and wish you a good rest of the summit. Thank you so much. Bye.